Welcome back to the Investing on the Go podcast. I'm Stacey West, and today I'm joined with Darius, McDermott, and Juliet Schooling Ladder for our quarterly market update. Thank you both for joining me.
Good afternoon, Stacey. It's our pleasure, as always, to be here.
Before we get into our usual quarterly episode, we have a bit of a special milestone to mark because today is our 400th episode. And I do want to go on record that I've not manipulated it in any way, only slightly, to both host this episode, but also have it released on my birthday. So that is coincidental.
That mean you won't be here to take calls if people don't like it?
Exactly. Conveniently out of office will be on. But joking aside, we started this podcast back in May 2019. So quite a lot has happened since that very first episode. So before we get into our normal views, I want to ask you both what your favorite part of the journey has been. And Darius, I'm going to start with you because when I was looking back, you have now hosted 57 of these episodes.
It feels like a little more, but if you tell me it's 57, I'm not going to argue with you. I mean, I think the basic thing is it's a privilege and a pleasure to have access to all these great fund managers, to try and quiz them, to try and make it interesting and topical of interests, whether it be in the bond market, the equity market, or alternatives, as and when we speak to these wonderful elite rated managers. And also I'm thankful to them because they're also very giving of their time and to the partnership that they have with Fund Caliber. As I say, hopefully we've been able to bring you a few helpful insights and tips over the years to help you on your long-term savings journey.
And Jules, this is your 22nd quarterly podcast. We started these in 2021 because a lot was happening. And so we thought we would give updates and views. And it is fair to say a lot has happened since we started doing these. What stands out for you in doing these quarterly updates?
Is it only 22? Yeah, a lot has happened in that time. As Darius says, there was COVID, and 2021, that sort of marked the end of the COVID lockdowns, which I was very grateful for. Such a strange time, and we've been dealing with the fallout really ever since, because the following year, we had inflation, supply chain issues, rapid interest rate hikes, and a stock market decline. And then, of course, we had the Ukraine war, an oil price shock, an AI-fueled stock market boom, and then a second oil price shock with the Iran war. And during that time, of course, the UK's had 4 prime ministers. And,
Only 4?
We're expecting to have 5. So, yes, it's certainly not been done.
So 400 episodes done. And here is to 400 more, if I can convince you both to stick around that long. So let's turn back to our normal day's events, which is what's been happening in markets over the past quarter. And we're going to wrap up the first half of this year. And last time we recorded, it was during a lot of volatility in markets because of the Iran conflict. We actually did something we've never done before, which was we recorded and published on the same day because things were moving so quickly and it was so volatile. So now we fast forward. Looks like we have a ceasefire. We have some type of, let's potentially say, end in sight. What do you actually think about how this is going to continue to impact markets?
As you say, there's been a lot going on since we last spoke about this. And yes, as we stand today, there is this ceasefire in place that's been going on for about 2 weeks and has seen the Strait of Hormuz sort of reopen to some extent. The oil price is almost back to pre-war levels at about $73 a barrel. And that's the key thing really here, I think, is the question is, will the ceasefire hold? And how quickly can oil reserves be built back up and consequently inflation reined in? So I think we're all sort of collectively holding our breaths and hoping that this ceasefire holds, really.
hoping that we're not talking about it in another 3 months' time and it's resolved itself.
Yeah, and I think the oil price is a key thing. I mean, it's been the most volatile asset. President Trump tweeted one way and then the other, and the oil price followed it. Juliet sort of wrapped it up, but there are different types of inflation. You can get inflation when you have a booming economy, everybody's working, everybody's spending, and then you really, central banks tend to raise interest rates to sort of calm the animal spirits, to make the cost of homes more expensive. And that's sort of used then to try and sort of subdue the economy. Speaking as we do here in London, I think there's limited scope for the UK, for the Bank of England to raise interest rates, at least not more than once. Because we do not have a booming economy. We have a depressed economy. We have a number of young people can't get work. I've had more emails for people looking for potential internships in the last week than probably the previous 5 years. So we don't have a booming economy, yet we still may have this inflationary lag from the oil price. So it's a key metric to look at today is the oil price. But with respect to the conflict in the Middle East, I mean, it never ends. It stops, it slows, it quietens, but it doesn't end.
Well, we have seen kind of this broadening of returns in markets with year-to-date performance. We've had Asia ex-Japan up around 30%. Global emerging markets about 28%, both comfortably ahead of global technology, which is about 27%. Japan was also very strong at 20%, and global and US equities much more muted around kind of 9 to 10%. So what is driving this broadening of returns away from what we have seen as the usual US leadership?
Yeah, I mean, you mentioned the key word, and it's technology and the AI trade. The first and still continuing wave of the AI trade is in the US stock market. There's no doubt about it. But we talked about Asia and then emerging markets, where there is huge overlap. Obviously, the Asian part of emerging markets, China, Taiwan, Korea, and things like the Korean stock market. I haven't checked for the last couple of weeks, but it was up 100% this year and probably 700% last year, based on a handful of stocks which supply the memory to the AI trade in America. So that appears to be the dominating feature, given how strong Asia and emerging markets have been in the last, not just this year, but also last. There is definitely a convergence of that sort of AI trade, which investors need to just be aware of, that they've got exposure probably via their Asian funds. You think technology, you think AI, you naturally think the States. That's not what's been driving Asia. Asia's been driven by the technology in a slightly different part of the chain, but technology nevertheless.
Also, I think emerging markets have benefited from stronger commodity prices. And you mentioned Japan, which, whilst that's also benefited from the tech boom, they continue to undergo a sort of major corporate overhaul with companies becoming more shareholder friendly, and they've got sort of greater political stability there with the government sort of pro-growth policies there. So I think that's helped on the Japan front.
Well, let's stick with AI then for just a second, because it does dominate so many headlines and it's a kind of a natural place to gravitate to. But apart from just kind of software and some of the maybe more discussed names, there's more conversation about the infrastructure now behind it. So the hardware, the power demand, the data centers that you need to build, and this kind of broader supply chain to which you kind of referenced, Darius, in Asia. Is this still the same AI trade that we've just been talking about over and over, or are we entering kind of a new era of AI, something that's more capital intensive, and we're going to continue to see this broadening out?
Yes, I think it is going to continue broadening out. The AI story has, as Darius said, sort of shifted a bit towards Asia, and I think it's not just that. I think in Asia there's a growing middle class, and Asia's GDP growth, far outpaces the UK, with emerging Asia is projected to grow at sort of 4.9%, versus in the UK, we're only projected to grow 1% this year. And, the Asian governments are largely less indebted post-COVID than we are, with a sort of average debt to GDP of about 60 to 75% versus, over 100, 125% for developed economies. So I think these factors are also aiding them.
Yeah, I think all the sectors that you referred to there, Stacey, they're sort of derivatives of AI, power generation, the infrastructure behind them. There would not be the need for quite as many data centers if there wasn't this massive AI compute. So they're second derivatives. And I think if we go back to our previous question about the correlation and the concentration of some of these themes, it's probably 50% of all world submarket is in this high growth AI tech theme. Our other colleague is super enthusiastic about AI and the changes it's going to bring to all of our lives. What I think, we can already probably in our own jobs say we can be a bit more productive. But is it going to change the world? And what happens if AI starts to take people's jobs and robotics and all these sorts of things? So for me, it's not just a straight line, but I think the interesting thing is that concentration really in one theme now having spread to Asia. I mean, it was the US, hyperscalers, NVIDIA et al., bang, 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 up 100% every year, whatever. And then last year, it really did feed into Asia, and those strong, both year-to-date and 2025 returns are the same thing. It's just Korea, TSMC, and a few Chinese tech names. So I just think investors need to be aware of that. It's fine. I'm not saying it's a bad thing. I'm not saying it's a good thing. It's just a thing that people ought to be aware of, that concentration, not just now in the States, but globally.
And the amount of debt that's now having to be raised, is quite eye-watering, for this amount of capex that's required. I think we're likely to see some more wobbles in tech along the way.
Coming back to kind of the best and worst performers, we segued into AI a bit, but coming back to some of the worst performers, India has been a clear laggard this year. It is down about 7% year to date, alongside healthcare, which was down about 2%. But apart from those, most equity markets and sectors are in positive territory. So, Jules, you are India fan. What's been going on?
Yeah, believe me, I'm well aware of India's poor performance. I've been invested quite a lot there myself. So there's a few factors at play there. The fundamental problem is that foreign investors have been pulling out of India, which started last year, with high valuations there, basically, and more tempting AI investment opportunities elsewhere. And then this year you've had the Iran war, and India is a large importer of oil, and the higher cost of oil obviously impacts corporate profitability there. So I think if we see a definite end to the Iran war, then India's economic growth and corporate earnings are likely to sort of bounce back to their longer term trend. And foreign investors are likely to return. And, crises like this have often turned out to be good points of entry. And actually, India has been one of the top performing sectors over the past month. Up almost 6%.
Well, I'll outdo you with your short-termism numbers, because healthcare was one of the best performing sectors last week. As there was definitely a bit of a rotation from tech. But the simple answer why India hasn't done so well is it doesn't have an AI industry. It doesn't have any of the bits that fit into the food chain. So that if you said a major stock market was down 7% over a year, you probably wouldn't be that upset. But when everything else is up 25%, 20%, it all then gets relatively, that gap gets bigger. And everything that Jules said about starting valuations a couple of years ago, oil price, absolutely true, but it just doesn't have an AI industry that's been the main story in town.
So if you're trying to diversify away from concentration in both US and AI, India might be a good entry point.
Indeed, yes.
Yeah, I think that's absolutely fair.
Okay, so let's switch to Europe and UK, because UK M&A has been a little bit of a bright spot, with public equities increasingly acting as kind of buyers of smaller listed companies. So do you see this wave of kind of recent deal activity that we've seen as a sign of renewed confidence in UK, or is it just purely a valuation story and it's very much still an underloved market? It's just a good opportunity.
Yeah, so the UK has actually, in the past 2 or 3 years, done a bit better without the AI trade. And there have been other forces in play. UK stock market is full of oil companies and mining companies. As we know, mining and particularly precious metals were very, very strong in 25 and 24. And I think more money did flow back into the UK last year, but primarily into the larger companies. And aggressively, people tended to be buying more passive. I saw a chart only last week that actually says the UK large cap is now not super cheap, like around 4% to its intrinsic value on a method which is used by Holt, which is a valuation method used by a number of fund managers. But actually, the UK smaller companies, which we mentioned yet again, are now 50% cheap versus their intrinsic value. So the UK has been okay without the AI trade, but higher interest rates have been fabulous for the UK banking system. We do have listed on our stock market all the miners, which have been winners. We have some defence companies, which have been winners. And we have oil companies and AstraZeneca and Rolls-Royce. Some of these stocks have done extremely, extremely well, particularly Rolls-Royce. So you can still have a booming stock market or a good, strong stock market without AI, but UK's probably been the sort of standout differentiator from that theme.
Yeah, I mean, M&A obviously has been helping, but we've heard from some managers that even though companies are being purchased at a premium to their current valuation, they still think that they're being sold for sort of far below their true value, which is frustrating. And unfortunately, I don't think that the government provides that sort of environment to attract investors back to the UK. And I'm not entirely sure that the imminent change of Prime Minister is going to help to sort of allay this.
UK and Europe, because that was, I think, your question, which doesn't have much AI exposure. ASML is definitely a tech company and an AI winner, and one of, if not the biggest companies in Europe. But the second biggest company in Europe is Novo Nordisk, which has been a producer of these weight loss drugs, or the diabetes drugs. And that's sort of still from its peak. It peaked at just under €1,000. It's now €300. It's still the second biggest company in Europe. That tells you, a very big company has been dragging European index down. So outside of the UK, it really is still an AI theme. But European financials have done pretty well. The healthcare sector hasn't, but nothing like trying to buy something that's cheap. Things that have underperformed. You can't just have all of your portfolio in last year's winners or this year's winners. It's great if you can pick the right sector all of the time, then you will obviously do extremely well. And I think if you said to me today, on a 12-month view, I'd buy healthcare over tech all day long.
You heard it here first. With the M&A activity, though, is there an element of risk of this continued prolonged activity that we're seeing, especially in the UK, is just shrinking the opportunities for those UK smaller company funds that we love to talk about? Or is it going to benefit them with a re-rating in equities across the board?
There's been quite a lot of M&A. It looks like it's been in some of the mid-sized companies. There was a big bid last week by an American REIT, Prologis, to try and buy Serco, which is the largest UK REIT. But you're absolutely right. If we have a shrinking stock market, that gives us less, or gives the fund managers less to pick from. And again, our colleague James was talking about a number of the really, really large companies potentially looking to delist in London and go to the States, which would be hugely damaging. Because we have had, outside of that AI sector, we've got quite a broad stock market, but financials, got mining, got healthcare, and domestic economy. So, it is a certainly worrying trend at the moment, and not sure how we get out of that at the moment.
Your crystal ball's not working?
Bit fluffy on that one.
Yeah, I know. I mean, there's like some managers that we speak to are concerned about this shrinking set, and these are worrying. I think that, again, we just do need perhaps a more business-friendly government. And then, hopefully UK ingenuity will come to the fore, and UK smaller companies will flourish again.
Oh, that'll be the day. Right. So I want to finish with central banks, because last time we had a real sense of no one knows what's happening next. So just doing nothing is the sensible option. And we kind of just left it there. And we have seen the Bank of England hold rates for the fourth consecutive time. Again, effectively signaling this wait and see stance. But now that it has been ongoing, this wait and see, how do investors interpret that? How long are we waiting for?
I mean, the inflationary pressure, or the inflation numbers in different regions controls the local central bank's interest rate policy response. Since we last spoke, European Central Bank has raised rates once, and UK has declined to, and the US has declined to. And the US has got a different growth, not just the AI trade, but it's got its own energy supply, hence it's less affected by spikes in energy prices. There is inflation in the US, but there is a certain Mr. D. Trump definitely does not want rates to go up in America. They have got a new central governor, Mr. Walsh, and whether they're going to want to go against the pretty transparent view of the president of not wanting rates. I know they're supposed to be independent, but let's just see. But if inflation is high and persistently high in any region, almost for whatever the reason, then you would expect rates to go up. But in the UK, I'd be surprised if we might get one rate rise this year, but I don't think the economy is strong enough. And I think hence rates will stay at the current level for the rest of the year in the UK.
Well, I hate to agree with my comment.
As we know.
I mean, actually, I think markets are pricing in one rate rise. But I feel like it's unlikely, because inflation here is being caused by a supply side shock rather than increased consumer demand. So, often you raise interest rates so that you can sort of rein in an overheating economy. But that isn't the case here. We've got consumer demand is declining. We've got a very sort of wary consumer here.
Weak unemployment.
Yeah, weak unemployment. And the inflation is caused. I mean, it's not just the oil price shock, but we've had increased labour costs. Partly because we've got fewer workers post Brexit. Also, we've had the increased minimum wage.
And more taxes. National insurance.
So we've got sort of slower growth, and higher taxes are impacting both sort of consumer demand and also preventing business investment. So I think it's quite a difficult environment for the Bank of England to raise rates at the moment.
Well, on that ever cheerful note, what a way to end our 400th episode. Thank you both for joining me, and until next time.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on Fund Caliber's research methodology and are the opinion of Fund Caliber's research team only.